The United States, still the world's largest economy, and China, a fast-rising economic powerhouse, will dominate and drive financial markets for years to come. At the same time, there are trends that are rising in significance and are expected to transform and reshape societies and economies permanently. We have identified sustainability, healthcare, and artificial intelligence as megatrends that investors should keep an eye on. In this video, we shine the spotlight on sustainability. COVID-19 exposed weaknesses in our economic and social systems. This has led to increased scrutiny on whether governments and companies are conducting economic activities in a responsible manner. As a result, promoting resource and social sustainability will be a key consideration on how capital is allocated. This presents a new area of investment opportunities. In fact, sustainability-related managed assets are expected to grow from an estimated $30 trillion in 2020 to $160 trillion by 2036. The United Nations has published 17 Sustainable Development Goals, or SDGs, since 2015, which integrate environmental, social, and economic sustainability towards long-term development. With increasing awareness towards the need for sustainability, consumers are advocating for higher standards, while more investors are committing to the UN's Principles for Responsible Investment. Companies are measured by three key factors, known as ESG, that determine the sustainability and societal impact of investing in a company. By considering the impact of their business practices and decisions on the environment, companies can benefit from cost savings over the long term, delivering sustainable returns for shareholders. For example, Nike uses recycled materials in 76% of their products and has reduced waste by 1,500 tons annually, which lowers production costs. Companies that do not manage environmental risks may face litigation costs and reputational damage, which will affect their profitability. Companies such as Microsoft and Adobe that promote socially responsible practices, including gender equality and people diversity among their workforce, tend to attract like-minded consumers and businesses. Such companies tend to emphasize customer and staff satisfaction, resulting in greater customer and worker loyalty that helps in driving their growth. Companies such as Accenture and Visa that practice good corporate governance tend to align the interests of all stakeholders, including shareholders, management, and customers. These practices also help to prevent corruption and accounting fraud, thus improving investors' confidence in financial markets. Environmentally sustainable projects are deemed to have lower risks. Companies with such projects can therefore borrow at lower interest rates. This translates to potentially higher shareholder returns. Investor interest in ESG factors has been growing in recent years, as seen in the increasing issuance of green bonds. 71% of institutional investors globally are also expected to integrate ESG into their investment process by 2030. By incorporating ESG factors into investment decisions, investors can have the assurance that the companies they are invested in are more likely to generate long-term growth and profits. Consider companies that embrace sustainability to grow their business's profits, especially those that support causes that matter to you, such as conserving the environment. Investors need to watch out for greenwashing, where companies claim that their environmental policies are better than what they are. This could result in investors still being exposed to the risk of environmental lawsuits on the company. Investing in responsible companies allows you to do good while achieving sustainable returns. Speak to a UOB advisor today.